What's going on, guys? This is Lucas from the Early Retirement Club here. This is the digital extension of our club. And in this video, I'm going to show you how Warren Buffett has made nearly $100 billion on Apple stock. This making the iPhone maker one of the billionaire investors' best investments ever. We will show you a very valuable method to pick winning stocks like Mr. Buffett. A method that we call the Buffett's rule of 10 times pre-tax earnings. As you can see from this chart, Buffett started buying the majority of his shares around $27 to $35 in 2016 to 2017. He then doubled his position around $42 per share later 2017 and early 2018. Although note that the legendary investor also sold some of his shares between 2018 and 2020. And he missed out on about $6 billion of potential profit if he had not. Warren Buffett admitted that selling shares of Apple was probably a mistake on his part. He said that he sold the shares despite the fact that Berkshire Hathaway vice chairman, Charlie Munger, was against the idea. All told, Warren Buffett has spent about $35 billion buying his Apple shares. And these shares are worth a record $139 billion now. Making a profit of more than $100 billion US. Now let's see how he made so much money on Apple stock. This chart is the key. It shows the price history of Apple and 10 times its pre-tax earnings since 2010. Pre-tax earnings are also referred to as EBT, earning before taxes. As seen, Buffett made his major purchases when the price was below or near 10 times EBT. We were lucky enough to have added some Apple shares ourselves during that time. If you're a devout Buffett followers like us, you must have noticed or heard that the Grand Master paid about 10 times pre-tax earnings for many of his largest and best deals. And Apple is not the only one, but certainly most profitable one so far. Now let's see why paying 10 times EBT led to so many successes for Buffett. For readers new to the concept, earnings before tax, or pre-tax income, can be found in the income statement. When you get to the income statement, it is usually the last or second last subtotal found in the income statement before the net income line item. Now let's get back to see why paying 10 times EBT led to so many successes for Buffett. As investors, we face many risks. Two of the major risks are A. Quality risk or value trap, that is paying a bargain price for something of horrible quality. B. And valuation risk, that is paying too much for something of superb quality. The 10 times pre-tax rule helps us to avoid the type B risk after the type A risk has been eliminated. And that is a key reason why valued investors and disciplined investor like Mr. Buffett refuses to pay a high premium no matter how good a stock is. A stock, no matter how good it is, can become a disaster when bought at the wrong price. And the 10 times pre-tax rule provides a very reasonable guideline for the fair price to pay. For several good reasons. First, after-tax earnings do not reflect business fundamentals, and EBT reflects business fundamentals better. Taxes can change due to factors that have no relevance to business fundamentals, such as tax law changes and capital structure change. Such changes would impact the net earnings, but obviously have no relevance to the fundamental profitability of the business. Second, pre-tax earnings are easier to benchmark, say against bond earnings. When we speak of bond yield, that yield is pre-tax. So if we buy a good business at 10 times pre-tax earnings, we are getting a 10% earning yield return. Similar to a 10% yield bond. In this case, even if the business stagnates forever and its earnings never grow, we are already getting 10% pre-tax return. Again, similar to a 10% yield bond. Not the best investment ever, but owning a 10% bond return is not that bad either. If we get a business that offers any growth, then we will be buying an above-average business at an average price. And we will have a large chance of a double-digit return compounding for a long time. If you hold on to do it long enough like Buffett. In a nutshell, what we said is the core of Buffett's concept of an equity bond. Buffett said the best stock investments should be bond-like. And buying a good stock at 10 times EBT is a very good rule to buy good bond-like businesses. It provides a 10% pre-tax earning yield, directly comparable to a 10% yield bond, even it stagnates forever and never grows. Any growth will push our return into the double digit. And the compounding power at double-digit rate is simply mind-blogging. Especially if you hold on to it for a long time like Buffett. And Buffett's himself had plenty of successes with his 10 times pre-tax rule. He has made many of his best and biggest investments at prices near or below 10 times pre-tax earnings. The list is a really long one, ranging from Coca-Cola, American Express, Wells Fargo, Walmart, Burlington Northern, and of course the more recent Apple purchase. Finally, let's put the discussion under a broader context and discuss how we use Apple stock ourselves. As mentioned in our earlier video, we use two portfolios to manage our retirement funds. One conservative to take care of short-term needs, and the other one more aggressive, with a focus on growth in the long term. The more long-term portfolio includes more individual stocks we picked for their long-term return potential, and even applies a leverage to the stock holdings. Apple is a core holding of our long-term portfolio, helping us with the long-term growth need. And we are very glad of the performance of both the Apple stock and also our long-term growth portfolio, as you can see from this chart. This chart shows the performance of the aggressive model portfolio over a longer period of time. The performance of the aggressive portfolio is shown by the blue line since 1994. And the performance of the overall market, the S&P 500 index, is shown by the red line. As seen, the performance is compared during a 15-year period, from 2006 to 2020. And the aggressive portfolio outperformed the S&P 500 index most of the time. It really took off and began to dominate the S&P 500 index shortly after the 2008 Great Crash was over. In terms of dollar amounts, the aggressive portfolio outperformed the overall market almost by more than 200% in the past 15 years. For $10,000 invested in the overall market, it has grown to $30,000, not that bad. However, our aggressive portfolio has growth more than six-fold, to almost $65,000. Truly impressive. This portfolio is our real portfolio. And we adjusted it monthly. The returns included dividend reinvest. We will update it and discuss more details, such as how we use the leverage in a disciplined way, in our future videos. With that, hope you've enjoyed the video and we will wrap up here. To summarize and recap, Buffett made a profit of more than $100 billion on Apple stock. More importantly, he paid for the majority of his shares near 10 times pre-tax earnings. He has shown it repeatedly as a winning strategy to buy good businesses at fair prices. It is equivalent to buying a 10% yield bond, with potential growth built in the coupon payments. Thanks so much for watching. And see you next time.